Okay, so a quick recap of our journey. Since the middle of November until early April, I've been giving warning signs in my videos, signaling a potential correction. The rationales I gave to you guys were, number one, high CPI versus the Federal Reserve's target. Number two, Trump's push for a rate cut despite the high inflation. Number three, implementation of tariffs, which may lead to an even higher inflation. And number four, strong key data, including the ISM, PMI, and consumer confidence, which may solidify the current inflation level. In early April, I said that it is time for us to consider buying into the market, given, number one, the lowered valuation of big techs, which was showing 20 to 25 times price to earnings ratio versus 30 to 35 times a few months back. Number two, political noise generally goes away quite quickly after lingering in the market. And number three, a potential rate cut in the second half of 2025, which may boost the market valuation. Okay, so post-April, I gave a few more rounds of market updates explaining why the market is hitting the all-time highs, as well as some thoughts which may be going on inside Trump and Powell's heads. I also walked through some of the key events that are happening in the market, including the big beautiful bill, the tariff, stablecoins, and the Federal Reserve's reactions to the market. Okay, so after our last market update, there were another round of key data that came out. Let's look at some key numbers. US GDP growth for the second quarter, 3% versus 2.5% forecast versus minus 0.5% last period. Consumer confidence for July, 97.2 versus 95.9 forecast versus 95.2 last month. Core PCE price for June, 2.8% versus 2.7% forecast versus 2.8% last month. S&P manufacturing PMI for July, 49.8 versus 49.5 forecast versus 52.9 last month. ISM manufacturing PMI, 48.0 versus 49.5 forecast versus 49.0 last month. Now, the data which everybody was waiting for also came out, which were core CPI for July, 3.1% versus 3.0% forecast versus 2.9% last month. CPI for July, 2.7% versus 2.8% forecast versus 2.7% last month. Okay, so let's try to interpret the data. Basically, based on the data itself, what it's telling us is that, number one, US economy is strong with high growth and stable consumer confidence index. And number two, manufacturing activities are still below 50, so slightly below the break-even level, but not far off. And number three, inflation is still high, which is now starting to reflect some tariff impacts. However, the numbers were within the expected range. Now, as all of you are aware, while not many investors are focusing on the data in recent months, the market was paying a lot of attention to the CPI, given it will impact the direction of the interest rate cut, which is expected to happen in September. Okay, so the conclusion we can make is that, number one, none of the data was a surprise to the market. And number two, because there were no surprises, the market continued to move upward, though the momentum was slower. And also, number three, given the CPI was within the expected range, the market is still comfortably pricing in rate cuts to happen during the remaining year. Okay, so nothing meaningful really happened. I will say, though, that because everything was within the range of the market's expectations without much positive surprises, the market was not going too frenzy, but was showing a modest movement. Now, a lot of you may have seen from my previous market update video where I explained about why the market keeps on hitting the all-time highs. To summarize, I explained that, number one, while the market was super negative on Trump implementing extreme tariff plans to all the countries, the 90-day pause basically changed the whole sentiment. I explained that Trump's such actions was beneficial for both the market and Trump, given the market now has gained the confidence that Trump will revoke whatever plans he puts out whenever the market drops. So investors don't need to worry about the market going down because of Trump anymore. And from Trump's perspective, he now regained the market's trust, and given the market thinks he will revoke whatever he said if market goes down, he now doesn't have to worry about the market going down because of what he does. Number two, I noted that Trump is not focused on inflation at the moment and is trying to fix the twin deficits. I noted that Trump is trying to use, number one, the tariff to decrease the trade deficits, and number two, the big beautiful bill to protect consumer spending power, which may be impacted from the additional inflation, which may come from the tariff. And number three, stablecoins to increase the demand for US treasuries to roll over the country's debt. And number three, I also noted that with the Trump issue and the inflation issue resolved, the market now doesn't have to worry about strong economic data as no one cares about inflation anymore. Okay, so those were my speculations on why the market is going up at the moment. Now today, I wanted to expand on this topic a little bit by taking a closer look at the actual policies and political agenda which are driving the market up and how these policies are reshaping in recent months. Okay, so I kind of gave you guys an idea on why the market is making serious upward movements in recent months. Now, to explain this further, basically the market is betting on three puts. Now, just for your reference, when I say put, basically just think of it as a cushion for the stock market. In finance term, a put option is something which allows you to get your principal back at a certain rate, even if you're recording a loss. So while the word put I'm using here is just an analogy, just think of it as a line of defense for the stock market investors. Now, as I mentioned previously, the market is assuming that there are three puts which they can potentially rely on. Those three puts are Treasury put, Trump put, and the Federal Reserve put. Now, the Treasury put refers to something which the Treasury of the US takes on more debt to provide more liquidity to the stock market. Basically, this is government saving the stock market, and a good example of this happening was during the Lehman crisis when the government adopted the Troubled Asset Relief Program, aka the TARP. Now, Trump put is something different. The market is not betting on the government or the Federal Reserve or any other institutions coming to save them, but it's basically a bet on one man, Trump. During Trump's first term, the market experienced so many cases where Trump boosted the stocks by maneuvering the messages conveyed to the market that it turned into some kind of a cult, with the market thinking that Trump will drive the market up no matter what. Basically, this is what happened from November 2024 when Trump was elected until around early February of 2025 when the stock market continued to go up. Okay, now the Federal Reserve put is the Federal Reserve coming to the rescue to save the stock market. Now, don't get me wrong, the Federal Reserve's goal is not directly saving the stock market. The Fed's role is to reduce unemployment, watch the inflation, and avoid the US from heading into a recession. But coincidentally, generally, the actions which the Federal Reserve needs to take to achieve their goals often leads to providing more liquidity to the stock market, leading the stocks higher. Good example of this is low interest rate and the QE. Okay, so those are the three puts. Now, let's look at what happened to each of the puts in the past few months. First, on the Treasury put. Basically, the Treasury did provide a put to the market with the One Big Beautiful Bill. What this bill does to the Treasury is it reduces the taxes collected from corporates, which potentially benefits those companies in return for a bigger deficit for the Treasury. Now, the market is happy with the bill, given it extends the tax cuts for corporates, which would lead to a boost in the earnings of companies, which would lead to a justification of higher valuation of companies. Now, the only concern the market had was the huge deficit which the Treasury would face. However, the Treasury and the government announced a counter to the concern with the tariffs, which they claim would offset the tax losses from the Big Beautiful Bill. Now, as you may have seen, the most recent tariff revenue data shows that the tariff revenue for the US is skyrocketing. It was only at around 7 to 8 billion level until February 2025, but in July 2025, it increased to almost 30 billion. Also, the market was concerned about the US not having the ability to issue as much bonds as they used to due to the weakened relationship with other nations. However, that issue was also somewhat addressed with the Genius Act involving stablecoins. So with that, the market gained comfort and goes back to being happy. Now, second, on the Trump put, this is something which the market was extremely concerned about from February 2025 to April 2025. The market thought that Trump may not provide any support for the market, so headed downhill. However, as I mentioned in my previous market update video, Trump's 90-day pause on the tariff basically changed the whole sentiment around Trump and regained the trust in him. Okay, so up to this point, we can pretty much assume that the market enjoyed the effect of the two puts, which are the Treasury put and the Trump put. This is the reason why the market rallied so much during the past few months. Now, the only thing which the market does not have and was wanting so desperately was the Federal Reserve put. The Fed put is the most powerful put out of the three puts, and with this Fed put not perfectly in place, the market did show concerns from time to time. Now, as I explained multiple times in my previous video, the sole reason why this was happening was the inflation. The Federal Reserve is still repetitively saying that their target inflation level is 2%. The quote from the July FOMC statement goes, "The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to risks to both sides of its dual mandate." Now, however, the inflation rate still remains at around 2.7%, which, by the way, may go higher if more impact from tariff looms in. Now, as you may know, the main reason the market is concerned about the inflation is because the Fed generally increases the interest rate when the inflation is high. If the interest rate is maintained at a high level, that will negatively impact the valuation of companies, which will not be good for the stock market. Okay, now you have a good idea on what the market is thinking now. Let's take a look at some changes in the sentiment regarding this Fed put. Now, regarding this point, I would like to talk about two things that has happened in the market. The first thing is Jerome Powell's press conference, which took place on July 30th. Now, a lot of you guys may remember that I actually complained a lot about Powell not taking any stance on the impact of the tariff on the inflation level. I truly wanted Powell to show some kind of outlook on how the tariff will impact the inflation rather than just saying he doesn't have a view. Well, to my surprise, on July 30th, at the press conference, Powell did give his view on the tariff. Now, this is a quote from Powell's speech at the press conference. "Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remains to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-off shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed." Okay, now you can disregard everything, but just focus on one sentence in the middle. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. Wow, when I actually heard this, I was surprised for two reasons. Number one, Powell actually provided his view on the impact from the tariff. And number two, to my surprise, what he said is actually more or less aligned with Trump and Secretary Bessent's message. Okay, Powell did add a few caveats saying that the risk is to be assessed and managed. But what this basically means is that he thinks that the tariff is going to be a one-time thing, and after that one-time impact is over, it won't affect the inflation much. Basically, to give you more context, what Powell is saying is that whatever the tariff number is, whether it's 15% or 25%, this tariff will impact the price of goods one time when the tariff is implemented. However, it's not like the tariff is going to be applied on all goods every year, right? For example, if a price of a good is $100, a 15% tariff would make the price $115, and that's it. It's not like there's going to be another 15% on top of the $115 and then another one the year after. So what Powell is saying is that he now views the tariff to be a one-time thing that'll impact the price of goods, but nothing more. Now, this basically means that the chances of an interest rate cut is higher. Now, I won't say that this is equivalent to a Federal Reserve put, but this surely gives the market a lot more comfort, given the market now knows that pricing in interest rate cuts from the Fed was not a mistake. Okay, now, another news I'd like to mention regarding this point is, on August 7th, Trump nominated economic advisor Stephen Millen to be the new Fed governor, replacing Adriana Kugler. Now, I won't go into the details of who these people are, but I will just tell you one thing about them. The new Fed governor, Stephen Millen, has now been working with Trump since the beginning of his second term, and he will fight for Trump to bring the interest rate down. Now, one governor out of 7 governors may not change much, but this new guy will do whatever it takes within his capacity to accomplish Trump's agenda. Okay, so what does this mean for the market? We can safely assume that Powell's statements and the replacement of the Fed governor both indicate that rate cuts are more likely now. There could be debates on whether there will be 2 rate cuts or 3 rate cuts within the year, but what we do know is that there will be some rate cuts within the year. Now, this means that the market is now almost on the verge of getting what they wanted. the Fed put. Okay, with that, we can now conclude that the market is almost on the verge of getting the Infinity Gauntlet of Thanos with all the Infinity Stones placed in. However, how long can this last? Now, let's go into the predictions and implications. Okay, now here's my view. I do admit that the market has the three puts from the Treasury, Trump, and the Fed, which resulted in a super bull rally. However, the problem the market is now facing is whether there will be the next put. Trump put is somewhat losing steam. Treasury put has already been used. Fed put may come, but without a severe recession, it'll just end up being a couple of rate cuts, which the market is almost likely pricing in already. Now, in order for the market to continue to go up at this pace, I think a couple of things will be needed based on where we are now. Number one, the market needs to have further comfort that there will be 3 rate cuts rather than 1 or 2 within the year, which means a stronger Fed put. Number two, there will need to be further comfort that the SLR deregulation will be implemented within the year. Now, I'll explain about this in my next videos if I have the chance, but just think of it as a deregulation on banks to hold more assets and lend more. This is basically a stronger Treasury put. And number three, the market needs to have the comfort that the company's earnings will continue to outperform. Okay, so this is what I think is needed to keep the market going. I honestly think that all of the 3 drivers need to be somewhat in place within the year for the market to continue to go up. But if any one of the 3 shows a shaky movement, the market may experience some pullbacks. For now, my thesis still holds the same. Let's monitor the market closely, and whenever there's a pullback in the market, it may be an opportunity for us to buy more into the market. I hope you enjoyed the video, and I'll be back with more videos very soon.